Institutions have been quietly loading up on Bitcoin for years now. And sure, big money flowing into crypto sounds like great news for prices. But here's the thing that nobody's really talking about. Institutions now control over 20% of all the Bitcoin that will ever exist. Think about that for a second. 1 in every 5 Bitcoin is sitting in the hands of hedge funds, asset managers, governments, and corporations. So what happens when they stop buying and start selling? And even more importantly, could they eventually own Bitcoin entirely? These are the questions that keep serious investors up at night, and today on Web3 Verse, we're going to dig into all of it. Stay with us because this one is important. To really understand why this matters, we need to go back to where Bitcoin actually came from. Back to 2008. The global financial system had just collapsed. Banks that were considered untouchable had crumbled. Governments were bailing out the very institutions that had caused the crisis in the first place, while ordinary people lost their savings, their homes, and their trust in the entire system. It was in that environment that an anonymous developer, or possibly a group of developers, operating under the name Satoshi Nakamoto, released a document that would change the world. The Bitcoin White Paper. And the vision was simple but revolutionary. A peer-to-peer electronic cash system that didn't need banks, didn't need governments, didn't need any middlemen whatsoever. Bitcoin was built on fixed supply, transparent rules that nobody could change behind closed doors. A decentralized network secured by miners spread all around the globe. No central authority. No one who could freeze your account, censor your transactions, or quietly inflate the currency by printing more of it. It was designed to be the opposite of everything that had just failed the world. And for a while it was exactly that. A grassroots movement. A tool for people who believed in financial freedom and individual sovereignty. Something entirely outside the traditional financial system. But fast forward to today and Bitcoin looks very, very different. Major banks now offer their clients Bitcoin exposure. The world's largest asset managers have launched regulated spot Bitcoin ETFs. Public companies are putting BTC directly on their corporate balance sheets. And we've even seen entire countries adopt it as legal tender. Bitcoin is now being packaged, wrapped, and distributed through the very financial rails it was created to replace. And for many early believers in the Bitcoin movement, that is a deeply uncomfortable reality to sit with. So let's talk numbers because the scale of what's happening is genuinely hard to wrap your head around. Publicly listed companies alone hold over 1.1 million Bitcoin. And here's what makes that even more striking. Roughly 62% of that belongs to just one single company. Strategy, the firm formerly known as MicroStrategy, has been on an aggressive Bitcoin buying campaign for years now and has accumulated a truly staggering amount of BTC. Their CEO has become one of the most vocal Bitcoin advocates in the corporate world, and their strategy has inspired other companies to follow suit. And here's something that really puts this into perspective. Back in May of last year, one of the most respected analytics firms in the space projected that institutional ownership would reach 20% by the end of 2026. We are barely into the year and that threshold has already been crossed. The pace of accumulation has been faster than almost anyone predicted. Now, the obvious question is, what happens next? Because institutions buying Bitcoin is one thing, but institutions selling Bitcoin is a very different story. And we've already seen it happen. Riot Platforms, one of the largest Bitcoin mining companies in the world, sold over 1,800 BTC in December alone. This came after Bitcoin dropped roughly 20% over the previous 2 months, suggesting the company was either reducing risk or simply rebalancing. And they're not alone. Quantum technology, as it advances, has the potential to break the cryptographic encryption that protects Bitcoin wallets. If that happens, billions of dollars worth of BTC could theoretically be exposed or stolen. Many believe this threat is still years or even decades away from being practical. But institutions are by nature forward-looking, and forward-looking investors don't wait for a problem to arrive before they price it in. One prominent analyst warned bluntly that if Bitcoin developers don't tackle this issue urgently, we could see a Bitcoin bear market that makes everything that's come before look small. That's a serious statement and it deserves to be taken seriously. Now, a fair question at this point is whether all of this institutional ownership actually threatens the Bitcoin network itself. And the answer here is nuanced. From a pure protocol perspective, no. Bitcoin's security is built on decentralized proof-of-work mining. Holding large amounts of Bitcoin doesn't give you any control over the network. Even if institutions collectively hold 20% or 30% of all Bitcoin, that does not change how the blockchain operates or how transactions are validated. A 51% attack, where a single actor gains enough mining power to take control of the network, remains extraordinarily difficult and expensive to execute. You would need more computing power than every other honest miner on the network combined, running constantly, at an energy cost that would be enormous even for the world's largest institutions. It is not impossible in theory, but in practice it remains highly unlikely. That said, there are indirect risks worth keeping an eye on. If institutions begin acquiring significant ownership stakes in Bitcoin mining companies, hash power could become more concentrated over time. And because institutions don't typically use self-custody wallets, they rely on third-party custodians to hold their Bitcoin for them. This creates another layer of centralization risk. A compromised custodian, whether through a hack, fraud, or financial insolvency, could put enormous amounts of Bitcoin at risk simultaneously. This isn't purely hypothetical. There have already been cases of institutional-grade custodians experiencing serious security vulnerabilities and financial difficulties. No funds were permanently lost in the most notable recent cases, but these incidents highlight that even professional custody solutions are not bulletproof. So what does all of this mean for Bitcoin's price going forward? The long-term picture is actually quite compelling. As institutions continue to accumulate Bitcoin and hold it in their portfolios, the liquid supply of Bitcoin available for everyday trading shrinks. Less supply meeting the same demand naturally pushes prices higher over time. Bitcoin's price trajectory upward over the long term is supported by this dynamic in a meaningful way. There's also a strong stabilizing effect that comes with institutional involvement. As more and more capital quietly accumulates Bitcoin in the background, it creates what traders call a passive bid, a consistent underlying demand that provides stronger price support during downturns. Bear markets actually become an opportunity under this framework. Remember that 71% of institutional investors believe Bitcoin is currently undervalued. For them, any price dip isn't a disaster, it's a discount. They're likely to buy more, not less, when prices fall. That kind of patient, well-capitalized accumulation builds a stronger floor under Bitcoin's price over time. And there is a powerful signaling effect at work here that shouldn't be underestimated. When the world's largest asset managers, the most respected banks, and major corporations hold Bitcoin through turbulent markets and don't sell, they are sending a message to the entire world. This asset is legitimate. This asset is here to stay. That kind of institutional credibility attracts the next wave of investors, both retail and institutional, and the cycle continues. So where does this leave us? Bitcoin's institutional adoption is real, it's accelerating, and it's reshaping the asset in fundamental ways. The original vision of a decentralized currency free from Wall Street and government control has undeniably been complicated by this reality. The tension between Bitcoin's founding principles and its current trajectory is something the community will continue to wrestle with for years to come. But here's what we know. The capital is real. The infrastructure is real. The global interest is real. And for better or worse, institutions are now a permanent part of the Bitcoin story. The real question isn't whether institutional adoption will continue. It almost certainly will. The question is whether Bitcoin can hold on to its core identity while navigating this new reality. Whether decentralization, self-custody, and financial freedom can coexist with Wall Street's involvement at this scale. That's the debate that matters. And it's one that every person in this space should be paying close attention to. That's everything for today on Web3 Verse. If this got you thinking, drop your perspective in the comments below. We genuinely want to hear where you stand on this. Make sure you're subscribed so you don't miss what's coming next, and we'll see you in the next one.